You're listening to Confessions of a Bookkeeper, where we look at businesses through the eyes of their books. My name is Mark, your Chief Bookkeeping Officer, and I spent years cleaning up and reviewing some, let's say, interesting books. In this episode, we're breaking down the top 5 IOLTA mistakes we've seen in law firm books over the years, the kind that can quietly turn into compliance issues if no one's watching closely. These aren't theoretical examples or textbook errors per se, they're real patterns we've uncovered while reviewing and cleaning up law firm financials for firms that are already doing a lot of things right. Because when it comes to trust accounting, even good systems can fall out of balance when multiple settlements hit at once, several people touch the same files, or the firm's three-way IOLTA reconciliation isn't being maintained consistently. Each of these 5 issues has the potential to affect compliance, distort your reporting, or create downstream headaches for your CPA, not because of negligence, but because the process around it wasn't designed to catch it. So today, we'll walk through those mistakes, what they look like, why they happen, and how proper bookkeeping keeps your trust account, your operating account, and your three-way reconciliation perfectly aligned, month after month. First up at number 1 is misallocating multi-source settlement deposits. This first mistake happens when a case has more than one payer, maybe an insurance company, and a defendant, and even a county or municipality, all contributing to the same settlement. Most law firm staff are used to a single payment hitting the IOLTA, one deposit, one disbursement letter. But when multiple payments come in for the same matter, things can get complicated really quickly. What often happens is that only the first deposit makes it into the disbursement sheet. The other incoming payments, sometimes tens or hundreds of thousands of dollars, never makes it into the client's disbursement summary. The client gets less than they're owed, and the firm's own fee might be understated. On the surface, the IOLTA balance might still look fine, but when the three-way IOLTA reconciliation happens, the numbers stop matching. The firm's trust ledger shows funds unaccounted for and the financial trail breaks down. The fix, which is more procedural than anything else, requires a strong, consistent collaboration between case managers, accounting, and bookkeeping. Practice management software and bookkeeping software need to speak together as well. That way, when multiple checks or wires arrive days apart, nothing gets missed in the final disbursement. Because in these multi-source cases, accuracy isn't just compliance, it's about making sure your client receives every dollar that belongs to them. Coming in at number 2 is not recording advance costs as reimbursable assets, and this one's surprisingly common. A firm pays filing fees, deposition costs, or expert witness retainers out of their operating funds, but instead of recording them as advances to be reimbursed, they post them directly as expenses. That doesn't sound serious until tax time or client billing season when the numbers stop lining up. If the costs aren't tracked as reimbursable assets, the firm loses visibility on what it's owed, and the income statement doesn't reflect true profitability. It's not about padding your profit, it's about accuracy. When these advances are finally reimbursed from the client's trust funds or settlement proceeds, they should clear from the balance sheet and not inflate your revenue. Many of our attorneys think of them as mini loans to their clients. Firms that treat these advances correctly can instantly see what's recoverable from clients, what's still outstanding from them, and what's actually spent on their matters. It's not extra work, it's necessary work, as these transactions are part of your client ledger. In audit situations, financial institutions and underwriters would require these costs to be on your balance sheet anyways, so getting ahead of third-party reviews makes your firm's accounting operations that much stronger. Number 3 on our list is duplicate or miswritten checks to vendors or clients. Here's a mistake that looks harmless until it creates hours of tracing. A firm finalizes several settlements at once, reuses prior check templates, or rushes to meet deadlines. Somewhere in that process, a matter name gets copied incorrectly onto multiple checks memo lines. The result is that a frequently used vendor receives the correct payments, but several of those checks reference the same matter instead of being split among the right clients. The vendor gets paid, yes. The trust account still balances a simple one-way reconciliation, yes. So on the surface, it looks fine. But one client's ledger goes negative, showing funds dispersed that wasn't theirs, while another client's ledger still shows a positive balance after closing out the matter. When the next three-way IOLTA reconciliation happens, it all kind of falls apart. The ledgers don't align, and you're retracing every check and every deposit to locate the discrepancy. This isn't about intent, it's about procedure. Every trust check should list the correct client or matter name, and that detail should match both the firm's practice management software and accounting software. That single habit saves hours of cleanup, keeps ledgers clean, and ensures that when reconciliation happens, every dollar lands exactly where it belongs. At number 4 is pulling fees before they are earned. And this one's tricky because it can happen both ways. Sometimes a firm waits too long to pull fees, and other times they pull fees too early. When client settlements hit their trust account, the attorney's portion isn't earned until the matter is fully settled and all disbursements are finalized and signed off on by the client. Pulling fees too early, before lien resolutions or final client approvals, can look like premature income recognition. On the other side, waiting too long to pull earned fees leaves client ledgers showing inflated liabilities. It creates confusion for both the state bar and for the bookkeeper when reviewing the accounts later. The key is clear documentation. Once the disbursement sheet is approved and all third-party payments are confirmed, that's when the fees are earned and can safely move from IOLTA to operating. It's not about speed, it's about timing. And when timing matches documentation, every transfer stands on solid ground. For number 5, it's depositing client funds into the wrong account. And this last one might be the most preventable, but the most stressful. A client asks where to send a retainer, or a large settlement check arrives, and one of your staff members makes a deposit into the operating account instead of the IOLTA. No bad intent, just bad routing, but the moment it happens, client funds are commingled with the firm's funds, and that's a compliance problem. Even if corrected quickly, the paper trail is questionable and it can raise eyebrows at the state bar. It usually happens when procedures aren't clearly written. A client uses outdated wire instructions, for example, or a new employee doesn't know which account to use, or someone assumes all deposits go to the same place. The safeguard is structure. Incoming funds should be verified by matter and account type before a deposit ever happens. Every staff member who handles funds should have a written set of instructions for what belongs in IOLTA, what belongs in operating, and what requires attorney approval. Then, once deposited, record it immediately in your books, tag it to the right client ledger, and confirm it during the next reconciliation. We as bookkeepers, we can become quite keen on the typical retainer amounts for a client or the cadence of re-upping retainers. We can be a layer of review that can prevent a week's worth of troubleshooting. And it's that layer that separates a secure trust process from a risky one. Every one of these IOLTA mistakes, from misallocations to misdirected deposits, traces back to the same root cause: process without structure. When your firm has a process to keep every client ledger aligned with your trust bank balance and accounting records, then compliance becomes second nature. That's why the three-way IOLTA reconciliation isn't just an administrative task, it's the backbone of trust accounting integrity. The client ledger, the book balance, and the bank statement should always agree, and when they do, you can prove your firm's diligence at any moment. At Chief Bookkeeping Officer, we help law firms build exactly that: trust account discipline that supports growth, reduces risk, and protects your reputation. Because good bookkeeping isn't about just spotting mistakes after they happen, it's also about building systems that make them nearly impossible in the first place.